There is a parking lot in Fremont, California. Row after row of unsold Teslas sitting under the California sun, inventory that was never supposed to exist, because Tesla, for most of its life, didn't have inventory. It had a waiting list. In 2022, Tesla made $15,492 in gross profit on every single car it sold. By 2025, that number had fallen to $7,555. That is not a bad quarter. That is not a supply chain hiccup. That is the sound of a company's core business model breaking in half, while the stock market continues to price it as though none of it happened. That is the story we're telling today. Not the story of a company that lost. The story of a man who built something genuinely revolutionary, made a series of decisions that seemed rational at the time, and handed the future he invented to the people he dismissed. One decision at a time. The first thing you need to understand about Tesla's original advantage is that it had almost nothing to do with the cars themselves. Yes, the cars were faster. Yes, the range was better. But what made Tesla genuinely untouchable was the ecosystem surrounding the vehicle. Once you bought in, leaving was not a rational decision. It was a sacrifice. And Elon Musk understood something that the legacy automakers never did. The goal was not to sell you a car. The goal was to make you dependent on a platform. The supercharger network was the crown jewel. Over 50,000 chargers across the globe, all proprietary, all optimized for Tesla hardware, all seamlessly integrated into the navigation system, so the car routed itself to the nearest charger without the driver lifting a finger. Rival eFUM owners were fumbling with different apps, different adapters, different charging speeds on a network that felt like a beta product. Tesla owners just drove. The software made it worse for competitors. Over-the-air updates meant your Tesla got smarter while you slept. Rivals were still selling software upgrades as a dealership add-on. Tesla was shipping features like a tech company ships apps. The entire ownership experience was engineered to make switching feel like going backwards. That is not a car advantage. That is a platform advantage. And when built right, platform advantages can last a decade. The question was whether Musk could defend that wall, and in 2021 he made a decision that looked like genius, and turned out to be the beginning of the end. In 2021, Tesla did something nobody in automotive history had done at scale. They replaced hundreds of stamped and welded body parts with a single piece of die-cast aluminium pressed from a machine the size of a house, the Gigapress, a 9,000-ton monster that could produce in seconds what previously took dozens of robots and hours of assembly time. Wall Street lost its mind. Assembly time dropped 30%, from 12 hours to under 10 per car. Annual savings were estimated at $266 million across Tesla's production volume. Gross margin peaked at nearly 30%. Tesla looked invincible. Musk looked like the only CEO in the world who understood what a car factory was supposed to be. But here is what nobody said out loud at the time. The Gigapress was not a secret. The machines were made by Hydra, a company that sells to anyone with the money. The alloy formulations were reverse engineered within months, and the blueprint was visible in every car Tesla shipped. BYD, Xpeng, NIO, Geely and Xiaomi all began ordering Gigapress machines within 18 months. Ford and Hyundai bought units from the same Italian supplier. Volvo signed deals for two 9,000-ton presses for its new Slovak factory. Even Toyota, the company that once defined global manufacturing efficiency, sent engineers to study the process. Tesla had spent years perfecting a technique that competitors could replicate simply by placing an equipment order. The head start was real. The moat was not. And right at this moment, when every rival on Earth was copying Tesla's factory floor, Musk made the second decision, the one that ended the story that had taken a decade to build. In 2023, Tesla opened its supercharger network to rival automakers. Ford went first, then GM. Then nearly every major manufacturer in North America committed to adopting Tesla's charging connector as the new industry standard. The headlines celebrated this as a Tesla victory, proof of dominance. The world had chosen Tesla's plug. Look more carefully at why it happened. Tesla began rolling out V4 supercharger posts in late 2023, featuring built-in payment terminals, That upgrade made Tesla eligible for a share of the $7.5 billion in federal NEVI infrastructure funding. To qualify for the federal money, Tesla had to open its network, so it did. The supercharger was not shared because Musk wanted to be generous. It was shared because the federal grant required it. The short-term math looked attractive. Federal funds flowed in. The stock got good headlines. But the strategic cost was staggering. The supercharger network was the single biggest reason a rational buyer chose Tesla over a competitor. The charging anxiety that plagued rival EV owners was Tesla's silent salesman, working 24 hours a day. The moment Tesla opened the gates, that anxiety disappeared for everyone. The walled garden became a public park, and Tesla handed out the keys voluntarily. But while that surrender was happening in public, a quieter one was already complete. Competitors had not just looked at Tesla's cars, they had disassembled them in their own R&D labs and worked backwards through every design decision. GM went further than most, acquiring a supplier that had originally helped Tesla develop its gigapress technology. That is not inspiration. That is extraction. BYD, operating in a manufacturing environment with no obligation to keep methods exclusive, replicated not just the process but also improved the unit economics. Two advantages. One was given away on purpose, one taken without anyone noticing, and the company that had both, in 2021, had neither by 2024. They gave away the network and called it a victory. They lost the factory playbook and didn't even know it was gone. What remained was the brand, the software, and the valuation story Wall Street had built around both. And all three were about to take severe damage, starting with something that hit Tesla's buyers before it hit Tesla's balance sheet. Picture this. You bought a Tesla Model Y in October 2022. You paid $65,990. 6 months later, Tesla cut that price to $52,990. Your car lost $13,000 in value while it sat in your driveway. You didn't make a bad investment. You bought a product that the company that made it decided was worth $13,000 less than what you paid while you owned it. That scene played out for tens of thousands of Tesla owners simultaneously, and it marked the moment the brand stopped being aspirational. There is a specific inflection point when a premium product stops feeling special and starts feeling ordinary. It rarely gets announced. It happens quietly, in the minds of millions of buyers at the same time. For electric vehicles, that moment arrived between 2022 and 2024. Battery costs fell. Government subsidies expanded the market. BYD launched the Seagull in China for roughly $10,000. Hyundai's Ioniq 6 won the Global Car of the Year. Volkswagen pushed aggressively into the compact EV segment. Suddenly, Tesla's entry-level Model 3 did not feel like a steal. It felt like one option among many, and an expensive one. The psychological shift happened faster than anyone predicted. EVs moved from status symbols to commodity appliances. The early adopters who chose Tesla because it said something about them, their sophistication, their taste, their values, began to notice that their neighbor was driving a Korean EV for $8,000 less. The tribal identity fractured. And Tesla, rather than protecting the premium positioning that justified its margins, responded the only way a company in genuine demand trouble responds. It cut prices. Repeatedly. Aggressively. Desperately. And that single decision started a chain reaction that destroyed years of brand equity in approximately 18 months. The price war was not a strategy, it was a confession. On January 12th, 2023, Elon Musk did something no CEO of a luxury brand had done in modern memory. He cut prices across the entire Tesla lineup by up to 20%, overnight, with no warning to the dealers, to the owners who had just taken delivery, or to the investors who had priced the stock on the assumption that Tesla's margins were structural. What he was really announcing, though nobody said it out loud that day, was that Tesla could no longer move cars at the price that made the business work. The numbers that follow tell the story in the language of money. Gross profit per vehicle, $15,492 at the peak in 2022, down to $7,555 by 2025. That is a 51% collapse in the profit generated by the company's only real product. Automotive gross margin, which had touched nearly 30% at its height, compressed to 17.8% by 2025, and that figure includes regulatory credits, which are payments from legacy automakers covering their own emissions shortfalls. Strip those out, and Tesla's automotive gross margin on actual car sales dipped negative for the first time in 2025. The company was losing money on the business it spent a decade building. Revenue per car tells the same story from a different angle. When Tesla sold only premium vehicles, average revenue per unit approached $94,000. By 2025, it had fallen to $42,494. The company was selling cars to a different customer at a different price point with economics that no longer supported the valuation it was carrying. And the price cuts did not work. Deliveries fell 9% in 2025, the second consecutive annual decline. The Model 3 and Model Y, launched in 2017 and 2020 respectively, still account for more than 97% of everything Tesla sells. Factories in Berlin and Austin are operating far below capacity. The Cybertruck, positioned as the next revolution, used only a quarter of its 125,000 unit production capacity in 2025. BYD, the company Musk once laughed at on live television, shipped 2.26 million pure electric vehicles in 2025 against Tesla's 1.64 million, becoming the world's largest EV producer by volume. The company he dismissed is now setting the global benchmark on price, efficiency, and vertical integration. And behind BYD, dozens of Chinese, Korean, and European manufacturers are competing with more models, lower costs, and no mythology to protect. Tesla had competed its way down to being a normal car company. There was just one problem. Nobody had told the stock market yet. When a company can no longer win the fight it started, there are two choices: acknowledge the new reality and compete within it, or announce that the fight no longer matters and pivot to a different war entirely. In Q4 2025, Elon Musk chose the second option. On the earnings call, he announced that both the Model S and Model X, the vehicles that gave Tesla its identity, which made the brand aspirational before aspirational became unaffordable, would cease production in Q2 2026. The Fremont factory would be retooled, not to build a new car, to manufacture Optimus, a humanoid robot, at what Musk described as potentially the most important product in Tesla's history. This is the part that requires you to hold two things in mind at once. Optimus may, eventually, be commercially significant. Humanoid robotics is a real field with real investment and real progress, but no confirmed commercial deployment exists at scale. No enterprise customer has signed a contract for thousands of units. The $30,000 price point Musk has indicated targets a buyer that does not yet exist as a mass market. And the company making this announcement is the same one that has been promising full self-driving capability for 7 consecutive years. What you're watching is a car company trying to escape the consequences of being a car company by becoming something else before anyone notices. The supercharger advantage surrendered. The gigapress head start competed away. The brand premium traded for market share. The margins halved. The deliveries have been in decline for 2 years. Every structural edge Tesla built has been eroded, copied, or voluntarily given up. And now the company is betting its entire narrative on a product category that has never generated $1 of mass market revenue anywhere in the world. Here is the hard truth about electric vehicles that Tesla never wanted to say out loud. EVs are not software. They cannot be updated to obsolescence. They cannot be patched to defeat a competitor. They are physical objects made of steel, aluminium, and lithium, assembled by human hands on factory floors, sold in a market that responds to price above almost everything else. The electric vehicle revolution is the best thing that has ever happened to Tesla. It is also the thing that prevented Tesla from ever becoming what Wall Street believed it was. Because the moment EVs became real products that real people bought in real volume, the same brutal economics that govern every physical industry applied to Tesla too, and Tesla, which had been priced as though it existed outside of those economics, had no answer for them. This is where the story becomes personal, not for Tesla, for the people holding the stock. Tesla's PE ratio as of mid-2026 sits at approximately 330. To understand what that means, investors are paying $330 for every $1 Tesla currently earns. Toyota charges $9 for the same bet. That gap is not irrational on its own. Growth companies trade at premiums. But the premium requires a belief in a specific future, that Tesla will dominate autonomous software, energy infrastructure, and humanoid robotics at a scale that justifies a valuation no conventional automotive metric can defend. And here is the behavioral finance problem underneath that belief. Retail investors who bought Tesla at any point in the last 3 years have an enormous psychological stake in the software company narrative. To acknowledge that Tesla is behaving like a struggling automaker would require them to accept losses that feel personal, losses that carry the particular sting of having been publicly optimistic about a company they believed in. So they hold. They explain away the margin collapse. They cite Optimus. They cite robotaxis. They cite FSD timelines that have been revised so many times that the revisions themselves have become a genre. In 2024, regulatory credits surged to $2.76 billion, accounting for nearly 2/3 of Tesla's profit in some quarters. Those credits are payments from legacy automakers who cannot yet meet emission standards, and competitors paying Tesla to stay compliant. By Q2 2025, credit sales had already fallen more than 50% year over year. Estimates place the revenue stream effectively at zero by 2027. The profit Tesla has been reporting is partly a subsidy from the competition. When that ends, the earnings picture changes dramatically. The market is pricing a company on a story that the company's own numbers have already disproved. Delivery volumes in decline, margins collapsing, core products aging, factory capacity is sitting idle, regulatory credit lifeline evaporating, and a pivot to robotics with no commercial proof point. This is not optimism, it is a denial with a brokerage account. Tesla built something that had never existed before. Not just the cars, but the belief that a startup could redesign an entire industry from first principles and win. That belief was real, and it was earned. The Roadster was audacious. The Model S redefined what a car could be. The supercharger network was the infrastructure that made electric vehicles a real choice for real people. The Gigapress changed how factories think about manufacturing. These were genuine achievements, built by thousands of engineers working on something that mattered. The tragedy is not that the competition caught up. Competition catching up is how markets are supposed to work. The tragedy is the sequence of decisions that turned a 10-year head start into a retreat. The supercharger network was opened with federal money. The manufacturing playbook is lost through open supplier relationships. The brand equity was traded away in a price war that didn't save the volumes. The core product line was abandoned for a pivot to a category that doesn't exist yet as a business. BYD overtook Tesla as the world's largest EV manufacturer. The company Musk once dismissed in public is now the benchmark. And behind it, an entire ecosystem of manufacturers is competing with better cost structures, fresher product lineups, and no mythology left to protect. The era of the Tesla monopoly is over. Tesla built the future of transportation. The tragedy is that it then handed that future to everyone else, one decision at a time. If this gave you a clearer picture of what is actually happening inside Tesla right now, not the story, but the numbers underneath the story, share it with someone who still thinks the original thesis holds.